Hi, everyone. Thank you so much for joining us today. We're really excited to be bringing you all a fantastic group of panelists today to discuss developing impact investing products for retail. Anna's going to be our moderator for today, so I'll leave it to her to kick everything off.
Great. Hi, everyone. So I'm Anna Smukowski, and today we're going to be talking about impact investing product development for retail clients. I'm excited to introduce my fellow panelists today as a proud CBS alum and a current worker in the impact investing space. So I'm joined by Jake Raden, the Director of Financial Products and Head of ESG at OpenInvest. Openvest is a technology-driven investment management firm that uses direct indexing and proprietary ESG overlays to create customized equity portfolios for clients. And then I'm also joined by Yuliya, and I'm going to totally butcher your last name, Tarasava, who's the co-founder of CNote, an impact investment platform that delivers competitive returns by investing in women, minorities, and low-income communities across America. And then Jodi Waber, the managing director and head of syndicate at Incapital. Jodi focuses on fixed income placement across sectors as the head of syndicate, and also manages Incapital's legacy platform, which provides issuers and financial professionals the opportunity to offer investors a broad range of products that align financial goals with personal values. So as I mentioned, I'm a proud CBS alum, and I'm really happy to be back today to moderate today's panel. As an impact investor, my organization, the Local Initiative Support Corporation, has invested over $24 billion in communities of opportunity across the United States. We were the first community development financial institution to tap the capital markets in 2017 with a $100 million sustainability bond issuance. And looking to further diversify our capital strategies, we launched the LISC Impact Note, $150 million retail note offering last November with Incapital as our lead sales agent. And just to ground things a little bit more, providing retail investors the opportunity to invest in line with their values is a topic really near and dear to my heart. As a nonprofit employee, getting that accredited investor status is a little bit more challenging. So I'm really excited to be joined by my fellow panelists to discuss both the barriers and opportunities in impact investing, specifically around retail product development. To kick things off, I'm going to turn it over to Jodi to give a little bit more of an overview of the Incapital platform and to talk about how they reach retail clients through their product offering.
Thanks, Anna. And thanks everyone for joining and expressing interest this evening. So Incapital is a broker-dealer, and we were founded based on the idea that the individual investor should have the same access to corporate bonds as the institutional investor. And we have been distributing that product to individuals and institutions since 2001. All along the way, we had various issuers join the platform, very well-known household names, such as Ford, GM, Verizon. We've had supranationals on the platform, World Bank and IFC. Calvert, Impact Capital, a long-time issuer since 2005. Then in 2017, the first CDFI joined Capital Impact Partners. And not too long after came LISC and then Century Housing. And Incapital, prior to the CDFIs joining, decided to help our clients. And our clients include other broker-dealers, institutions such as insurance companies, pension funds, and various governments, municipalities, so that it runs the gamut. We decided to, based on their feedback, to help them find impact investments more easily. So we created a platform called Legacy. And what Legacy does is highlight those issuers that are dedicated to providing impact, such as LISC, Capital Impact Partners, Century Housing, the Supranationals, Calvert. It brings them together. It's a way for issuers and advisors to show clients what is available for them to, if they want to express their impact views through fixed income. So thank you all tonight for joining, and I look forward to explaining a little bit more about how to reach the retail investor as we go on today.
Okay, great. And just to further dive into the Incapital platform, I know in our initial discussions, there was some difference between how Incapital defined retail and some of the other platforms. Can you quickly go through how Incapital reaches retail?
Sure. So Incapital itself does not have individual retail representatives. So perhaps someone in the audience, for example, has an account at Fidelity. Incapital will sell product to Fidelity, and Fidelity will sell it to you. Right? So that's how we would define a retail client. In that representation, Fidelity to us is retail. On the other hand, you want to take the other type of investor that we service would be an institutional client. We would sell directly to an asset manager that might manage a mutual fund. We'll sell directly to an insurance company who purchases fixed income to help manage its portfolio. That's how we differentiate retail versus institutional.
Great, thank you. And then Jake, I'm going to turn it to you. I know OpenInvest defines retail a little bit differently. So can you provide an overview of the OpenInvest platform and how you reach retail clients?
Yeah, I'd be happy to. Thanks. And it's nice to talk to everybody tonight, or this afternoon, I guess. So OpenInvest today only builds portfolios out of public equity products and securities. So, you know, there's long been varying amounts of kind of like pushback or questions around, can you do impact investing in public equities, right? And whether it's retail or not, sort of this idea like, can you do impact through equities? But I mean, if we're talking about access and democratizing access, and that's what, you know, classifying someone as like a retail customer is really all about, right? As there's no barrier to access, they can go and buy this thing themselves. You know, one of the most bedrock fundamental asset classes that an individual who makes their own investment decisions has to be in is in equities, right? But any kind of efficient market, you know, asset allocated portfolio would put someone in, at least to some degree, in equities. And so it's not a question of can you, it's a question of how do you do it, because people are going to do it and people want it. And so at OpenInvest, like a lot of other, or a few other competitors at the time, back in 2016 when OpenInvest launched, you know, the definition of retail was someone who fires up their internet browser or an app on their phone and makes an investment decision. That's a retail investor, right? I think that's similar to how, you know, Schwab would think about a retail investor, someone who comes to their platform and buys some things on their platform. And that's, you know, that's a view, to sort of, you know, Jodi's point, that's specific to having someone be able to just come and buy that thing directly from or through you, as opposed to having an intermediary or someone making decisions for them. So, you know, in the beginning, that's what we were focused on. We had an app, individual would make an account or transfer money in, deposit it, whatever the assets are coming from. Sort of explain to us what they care about from a values and ESG alignment perspective. You could only do it on the S&P 500, and then we build you a direct index portfolio, you know, as of that day that reflected those values, and also would, you know, track the S&P 500 well. So direct indexing is take an index, have some decisions you have to make about that index, and as closely replicate the performance going forward of that index by choosing different securities or different weights of the securities in that index to essentially replicate it. And so, you know, if you have an ESG overlay that says, I don't want any fossil fuels in there, then how do you slice and dice and recreate the S&P 500 such that you get performance like the S&P 500 over time, but that doesn't have fossil fuels in it? That's what OpenInvest seeks to do. And so, yeah, originally that definition of retail was the person who'd come and do that themselves. We have pivoted as of, I want to say like 2018, which is right before I joined, to focus on what's now sort of our core customer, which is people who have advisors. So people who have, it doesn't have to be a lot of assets, but enough assets to want to use a financial advisor. And so our primary customer now is the advisor who serves sort of mass affluent, or we can go lower than that too. Frankly, anyone who has an advisor and up. So that's kind of how we define retail. So essentially non-institutional. To Jodi's point, that you have very different characteristics of clients who are technically institutional clients. Account sizes are larger. They have investment committees. They tend to have very different types of ESG and impact goals and rules and considerations. And so that's really how OpenInvest looks at it. We look at it, we call it channel one. That's our people with advisors, and then the institutional channel, where it's some organization's money as opposed to a person's money. Somewhere in the middle, in kind of an ambiguous area, you have family offices or ultra high net worth, which can look a little more like institutions or retail, depending on who you're talking about and how their operation is set up.
Great, thank you. And finally, I'll turn to Yuliya and ask a little bit more about CNote. I know Jake used the buzzword that I love around democratizing access to impact investing. And CNote's goal is to really do that for both the funds and for the investor. So I think CNote has stayed really true to the model in scaling investment from retail clients, and would love to hear a little bit more about how you do that.
Yeah, absolutely. Thank you, Anna, and thank you everyone for joining. So we started CNote about 5 years ago. I think we actually right around the same time as OpenInvest. So we kind of probably celebrated similar anniversaries. And the idea was really to offer more investment products to investors, retail and institutional, to invest with impact in asset classes such as fixed income and cash. I totally hear you, and Jake, and I totally agree that public equity is just such a massive asset class, and if anyone wants to invest, equity comes in our head right away, and this is probably the easiest way for us to start. Fixed income is also enormous asset class, and yet there's very few options available there on the impact side, and very often advisors, retail, you name it, different type of investors, they would be using bonds, municipal bonds, or government or treasuries to really get to that, or to use it as a proxy for impact vehicles. And obviously you can get there, only so close. So for us, we wanted to create true fixed income with 100% impact. And the way we do that is actually partnering with institutions such as LISC. LISC is something called CDFI, stands for Community Development Financial Institution. And there's thousands of those out there. And there's a huge asset class. And yet, for many, many, many years, access to them or participate or invest in their work was pretty much closed off for any type of retail investors. CDFIs have been primarily financed by banks and religious institutions, and tiny bit of that was coming from individual investors. And so in 2016, when we started CNote, we said we want to partner with organizations that do all this amazing work on the ground in underserved communities. They already, CDFIs already give loans to small businesses to build affordable housings, to build, grocery stores in food deserts. So doing all this amazing work for many, many, many years. And so the idea was, how do we find the way that we can invest in that work and give that opportunity for everyone to participate in? So we actually issued a note. Technically it's a bond. It's a bond that has shorter maturity, 30 months maturity. And we, went out there and we got an approval from Securities Exchange Commission saying, like, you can offer that note to non-accredited investors. Non-accredited investors is investors that have maybe like lower level of income or lower level of wealth. And pretty much, anyone can invest in what we call CNote note. There's no minimum. There's no, in terms of, you have to be a certain type of profile, and it's available on the platform. So you actually do not have to have a Fidelity account or Schwab account. You can just come directly on CNote, mycnote.com, and invest it in there. And that was very, groundbreaking at that time, because it was like very few options available like that. And right now we work with, across the spectrum. We have retail investors, we have a lot of college kids who wants to invest, like we have people that really thinking about fixed income as a part of their, investment allocation. And then we also work with, wealth managers and corporations and advisors. And so like our investor type really ranges from retail all the way to corporations with multi-million checks.
Great, thank you. And with that, I am a proud investor in both CNote and OpenInvest, but due to filing issues filing requirements in Washington State, where I'm located, I've been unable to purchase the LISC impact notes, which is my baby. So I'm a little upset about it still. So that's just one example of how complex some of the securities laws that govern retail product access can be. And I think that that's a common barrier that we see across the industry with issuers and organizations developing retail product. So Jake, I would love to hear a little bit more from you about some of the barriers that you see in retail product development.
Oh, sorry, I was muted. Classic Zoom problems. Yeah, I mean, there's a bunch, right? Even in equities. So, because once you're talking about retail investors, that's when the securities laws and FINRA starts to get really hairy, or at least a lot more specific, and at least as pertains to ESG in the past and up until now, kind of draconian, right? So, one of the biggest issues with ESG is sort of the lack of regulation and clear requirements and settled law and advisory notes from the SEC and all that kind of stuff. Like, when I started in this, almost 9 years ago now, like no one really knew what the SEC thought about marketing and talking about and doing this, and it has vacillated in that time to become more accepted to way less accepted now to back to assuming we're good to go again. And when in 2016, when we got an administration that was not particularly friendly to this type of investing, as evidenced by specific actions they took over the course of the 4 years in office, it shook a lot of weak hands, and they got out of this biz. And so, there's a lack in some ways of regulatory clarity. There is the extra scrutiny of marketing or doing business with retail versus accredited or high net worth people or advisors of those people who are in that case also the fiduciary and have certain responsibilities to the client. And so retail, you have to be in a lot of ways on top of the game more so than you do, at least on some of the marketing and documentation and books and records and stuff than you would otherwise, right? So that's a challenge on retail. Outside of like regulations and securities law and that sort of thing, there's the challenge of account sizes and AUM fees as a business model, the stickiness of funds, the continued sort of intransigence of custodians and brokers to make it easy to move accounts around, right? Like it's not easy to get someone to move an account from one place to another or to roll over. Like these are intentionally made to be difficult. And so if you're burning a lot of money on good engineers and good design and good product, trying to build a retail focused investing product, and you have a high customer acquisition cost to get those people onto the platform and move their assets, and then you've spent all that money and built that beautiful thing and gotten these people in the door, and then you realize the average account size is $1,000 and you're charging 25 basis points or 40 or even 50 basis points for management, you've got a long road to profitability and payback, right? And so you basically have to hyperscale if your business model is revenue on small balance retail accounts. and you better have a really, really low cost of acquisition because you're just not going to make it. And so that's what you saw with a lot of firms that started on this trend in like 15, 16, 17. I was at one called Swell previously, and we were actually scaling really well, but a combination of the cost of that scaling and the sort of direction that it looked like the administration was going, that really changed how our solo corporate backer really felt about the business model. That affected a lot of things that ultimately, led to us shutting down. And so, and like I said earlier, OpenInvest ended up pivoting. It's not, we still have a retail product, which we're actually really proud of, and interesting things to come there. But the main business model has been pivoted to be folks who have assets to be managed, because that's the business model, right? Otherwise, maybe you're charging a subscription fee to those retail clients that's vastly in excess of 1 or 2% of their assets you're managing. So you better have a lot of other things to offer them. And then you're talking about being a more, all kinds of financial product kind of marketplace, right? Nobody's quite done a great job of bridging that gap yet alongside of investment management. I mean, SoFi's trying to do it, right? There's a few platforms trying to do it. But most people haven't added investment management to the mix because it's complicated, and the payback is getting smaller and smaller and smaller over time.
Yeah, thanks, Jake. All right, and then Jodi, I know you have a little bit of a different flavor of barriers around access. So can you run through some of those?
Absolutely. So, Incapital does not sell equity product, and we sell fixed income. And with fixed income, it's less of a product that the individual investor seeks out on a name by name basis. Most individuals that do not have advisors express their fixed income through a mutual fund or an ETF, because that's the most efficient and most cost-effective way for them to do that. You can choose to purchase those mutual funds or ETFs that have a focus on impact investing, or perhaps they do negative screens. But if you want to be intentional, if you want to buy individual names, most likely the average retail investor without an advisor, they don't know what their options are. Even if they do have an account at a place like Morgan Stanley or Wells Fargo or Fidelity, they don't know that there are options within those systems. They don't know to look for them. So there's a huge information education gap, and that's something that Incapital is always trying to tackle, because what we do provide is an option for retail investors, those with and without advisors, to express their impact goals and still have a balanced portfolio and still strive to meet their retirement goals. But we are constantly faced with the challenge of making the downstream folks within our broker-dealer client networks aware of that fact. How do you do that? So what we've started to do is create marketing materials that have been reviewed by FINRA. And for us in the industry, having FINRA reviewed materials, it's a huge challenge and something that we're proud of when we eventually get something passed, because while FINRA does not sign off on the content to determine whether or not the investment has merit, what they have done is said, you've provided a balanced picture of the product that you are trying to present to the retail, the everyday investor. So suitability is a huge concern, and education is part of that process. How do we educate the folks that we interact with at Morgan Stanley or Fidelity? How do we educate them so that they can educate those within their system? How do we get it up into the system to make those that don't have an advisor aware of it? Can we partner with organizations to help spread the word? Yes, there are options for you that you're self-directing your portfolio. You don't have the type of wealth that merits an account that pays a fee per year based on your assets under management. You're paying maybe $7.95 per bond transaction. How do we get to those accounts and empower them to make these types of decisions? And so it starts even before you put on the ESG layer, the suitability standards. And I think once you couple it with what sometimes the SEC might call a promise of ESG, right? They want to know that number one, it's a suitable investment and you provide fair and balanced information about the merits and the risks. But then if on top of that, you're going to make any kind of ESG claim, the scrutiny is going to be greater. So those are the types of challenges that Incapital is facing. And I don't think that we're alone in that either.
Thanks, Jodi. I'm going to change a little bit more to another topic that we discussed in our panel prep around financial literacy and access more generally. Yuliya, I'd love to hear a little bit more around the opportunities that we as impact investors have in growing the financial health and well-being for those who are not part of the financial mainstream, talking about the people who might not even have that $1,000 to invest that are a large portion of Americans as another barrier.
Yeah, absolutely, and I do think financial literacy is something that we all have a role to play to help to fix this problem. But I think it's also a part of the problem why distributing and offering impact investment products to retail investors, it's still very hard and it's very, very costly on many fronts. I think both probably CNote and Openvest and many others, right, who started the companies, were very aspirational and very exciting idea, right, that we can create these products and people just gonna flood to our websites and they're just going to purchase it because, well, what not to like it, right? You can invest in the product and you can help to fight climate change and you can help finance a small business run by women of color in the deep south and change her community. And we very much believed in that idea, probably being naive, not fully understanding that it's part of that decision making. It's not just like the emotional appeal, but okay, I would love to do that. Yeah, it's going to be like good human beings, right? I want to ask how many you have. Like, I'm sure if you're going to do a poll right now, right? Like, if you ask, do you actually want to do impact investing? Everyone is going to say absolutely yes. Yes, I want to do impact investing. But then if you're going to do a poll a week later and say, hey, how many of you actually did something? I'm sure the numbers are going to be quite low. And it doesn't speak, it's not about that audience, that we have. It's really just the reality that we deal with, because to Jake's point, moving the accounts or opening the accounts or even, fighting that inertia that we'll have of making that financial decision is just, it's so hard and it's so high and you always have, some other things going on and it's always, being delayed, like filing taxes, right? I'm sure a lot of us can all wait till the last moment. It's kind of like this, right? Like if I know that my financial decision will always be only make impact like in 10 years, I have to think about it right now. Like I can think about it tomorrow. Nothing is going to change from today to tomorrow, but then tomorrow becomes next week and the next year and then it never comes. So I think to me, again, that financial literacy or lack of financial literacy is actually a part of why distributing and offering impact investment products to retail investors is hard, is because they're not just fighting, against like mainstream financial products, but you're really fighting, for that attention, right? And for that attention, that for that time, that competes with other, with other needs. But I think again, but I think there's also like sign of hope, like if you go on OpenInvest website, like if you go on CNote website, you have all this like beautiful stories, right? And this like really emotional appeal to that. No, like it's my decision, even $1, $10, or how many you're going to invest, like it's actually can give you the reward of, I don't know, saving their sea life, or again, fighting climate change, or again, building like affordable housing, and really seeing the faces, like real people faces behind those investment decisions. So I think, the bet that we are making is that there, while right now, like if you just say, hey, let's invest in Microsoft, and you right away think about, okay, like Microsoft is going to make more money and is going to, get more cash and is going to get more return, like that's great. But I think a lot of us think, okay, like Microsoft is going to benefit and then we're going to benefit. But I think if you really think about the decision investing in Microsoft more from the reason like, oh, actually Microsoft, and Jake, I don't know actually the statistics about Microsoft, so maybe it's not a good example, but I don't know if you think, for example, thinking about, Microsoft, right, like doing all the good things with their cash, right, or doing all the good things in terms of the employment practices, right, or being a leader or advocate for some health reforms, or whatever it is. Actually, I know nothing about Microsoft, but you know what I'm saying? It's just like if you can actually connect that investment decision to more of that, social change, then I think we're just going to get like more excited. And then to that point is like, well, hopefully Microsoft is going to do well. But even if Microsoft is not going to do well, like I still going to feel good because I know that my money is actually, doing something, right? Rather than investing in some, oil company. So I think again, I think what we are trying to fight here is that this add that emotional social component to the investment, we can actually help with that financial literacy and actually open up that interest or highlight or bring more visibility into that need of investing, because it's not only you're investing for yourself, but you're also investing for like a better world for all of us.
Thank you. And I meant to say at the beginning, we do have the question and answer box open. So if you want to, feel free to type in your questions and I can move over to them. I have a couple more questions for our panelists before going over to the audience Q&A. But one that I think everyone on this call may be interested in is the perennial question of how do you as students get involved in impact investing? And I know, I think all of our panelists have some thoughts on that, including myself who's hiring. So check out the website. Does someone want to take that first?
Anna, I'll jump in.
Okay.
From my seat sitting as a distributor of fixed income, I interact with many entities that touch the product. And so if you are an issuer of the product, there obviously are going to be opportunities with issuers that expressly are in existence to create impact, but also at those that are less traditional. Some of those that might be on our platform right now, a Verizon or a Ford, they are going to have needs as the conversation around corporate responsibility evolves, to build out those specific departments within those firms. You're going to see opportunities at issuers. You're going to see opportunities at the credit rating agencies that are now incorporating ESG criteria into the creditworthiness evaluations of different issuers. On the buy side, you have impact funds. You have funds that have carve-outs, right? Traditional funds, maybe you have a PIMCO, and they're developing more and more options for investors solely dedicated to impact, different scales, different flavors. The supranationals, right? So you have NGOs, you have second party opinion providers, those that are coming in and talking about issuers that are making claims about ESG, especially those offering fixed income products, what which is what I'm most familiar with. So there are going to be opportunities to work with them. And then there are consultants, and those are firms that come in and either advise issuers or they can advise clients, such as foundations and high net worth individuals and family offices. So it runs the gamut in my world, what I see as an increasing opportunity for those that are interested in working within the space. It doesn't matter if you want to work on the marketing side, if you want to work on the treasury side, human resources. There are going to be many, many more opportunities opening up within the financial world related to impact investing.
Yeah, Jake.
Yeah, I would follow up on Jodi's comment. The last part is a really interesting point that's like bears mentioning. Like, for a long time, the only roles in this stuff were you're a researcher or a portfolio manager who's done it before, or an analyst of some kind. And those jobs were super few and far between. Take it from me. And competitive. And so, it was really hard to break in. I think there's been a bit of a sea change though. One, because, things like the new EU regulation around sustainable finance disclosure has basically, it's like quietly the most important thing that's ever happened in impact and ESG investing, at least on the equity and fund side. And, just because it happened in Europe doesn't mean, one, it's not going to happen here, and two, it's not already affecting things here. Anyone who has a fund that gets marketed in Europe now has to care about ESG and sustainability. They can't ignore it anymore, or their fund doesn't get marketed. That's the way it works. So they work with some partner firm in Europe that distributes their fund. That partner firm in Europe now needs to know a whole lot more information about their funds than they ever needed to before to be able to market it certain ways or at all. And so every fund complex, every asset manager now has to take this seriously if they weren't already. And so once that happens, it opens up all these other roles, right? Like Jodi was talking about, marketing, copywriting, sales of the ESG products, business development, partnerships, account management, impact reporting and metrics and reporting, and not just financial reporting, right? Of course, there's still many and increasing numbers of those research jobs. And now there's all these intermediate firms, right? It used to be you did your own research, you built an ESG portfolio. Then it was, okay, there's a couple ratings providers. Maybe you work directly with them and buy some data to help you build your portfolios. Now there's all this stuff in the middle. There's the middleware. There's like, how do you aggregate all your ESG data? How do you report on your ESG data? How do you integrate your ESG data, right? And then also to Jodi's point, every company that's just a company doing business now has to care about this and issue sustainability reports. And I believe in the United States pretty soon we'll have to also disclose a lot of things they didn't have to before. And they need people to do that who know what they're doing. And so I don't think there has ever been anything even like the marketplace of jobs that there is today for this, and will be increasingly going into the future. Just before I shut up for a second, I've had a job alert on a couple different job websites for close to a decade, like ESG as a keyword and sustainable investing as a keyword. And I used to get like, for the first, until like 2 years ago, I would get like 1 hit a month. And in the last 2 years, it has hockey sticked up to like 50 to 100 a month. And it just keeps going up. It's insane. It was the most interesting accidental KPI I've ever created. Yeah, so there, just, if you care about this, make sure that that's apparent in the opportunities you take to work with other folks, the networking you do, the resume that you write, and the cover letters that you write, and the jobs you apply to. The jobs are there.
Yeah. Can I Anna, can I comment?
Yeah.
Can I say something here? I think I very much agree with what Jodi and Jake said, of course, and I would say maybe like a little bit of like a practical, note here. There's a lot of new stuff popping up around ESG. I think you definitely have to do your own homework on, is it real ESG? Is it greenwashing? And what type of companies actually are going to get involved? I would also say, ESG is not their stamp of approval of, the people that work there necessarily, unfortunately, and, the type of the company, they're still kind of like bad actors, like in that space. And I think at the end of the day, like a lot of people, they just want to, like the people that they work with. And so I would just be very, just mindful of the fact that ESG and impact investing, it's great, but it's also a lot about the type of company and the people that you work with. So definitely do your homework on the culture and the values and the mission and why people do what they do at those companies. And also just probably don't get discouraged. Like I think a lot of, and Jake, I'm not sure if you do that, but I know what we've been doing for a while is we have an internship program and we have a fellowship program, and we have a lot of people that are interested to get into the space, and that space is still very competitive. Like I think we should be very honest about it. I mean, myself, like I was trying to find a job in impact investing space 5 years before I started CNote, and I couldn't, and that's why I started CNote because I couldn't find a job for myself, and so I started this company. And so the space is really competitive, but I think there's nice ways to get into the space. And I mentioned about the internship and the fellowship, and we actually, and Anna can speak to that because she knows CNote very well, but we have a lot of people that started with us as interns, and they just proved themselves again and again and again, and then they just became employees of the company, because then you just get attached to those people so much and you like their work and you just don't want to let them go. And so I think, again, just like if you really want to be working in this space, there's definitely ways to offer your skills and to offer your energy and passion and desire to be involved. And then, good talent gets noticed, but definitely do your homework, and don't think that, ESG stamp or impact investing stamp absolutely, means your dream job, because there's still bad seeds out there.
Yeah, or just boring work, like all work is work.
That's true too.
I do boring stuff all the time.
I know.
I mean, that's
Right.
that is the nature of work. Unfortunately, sometimes there's boring stuff. You won't be safe from that hiding and impact in ESG. Unfortunately, you may have more of it, frankly.
Yeah,
You have to take the good with the bad.
Yeah, I think we're all a little bit of doing everything in our jobs, from planning things like this to I don't know, calendaring appointments. I feel like I'm my own admin. So
Agree there, but I think what I will have to say though, it's a bit more rewarding. There's still a lot of work. There's a lot of mundane things, like Jake was saying, and Yuliya. There's the everyday average things that anyone has to do, but when it pays off, when you have a success, it feels better. And I've done non ESG, just traditional finance, raising capital. But when I do it for the impact issuers, it's just a different feeling, because there is a story behind it. And it, like I've said during my narrative, it's intentional, and I can see the results of it. So don't lose hope when you're out there searching. You can find those gems of jobs.
Great. And that, I think, two of the things that both Jodi and Jake touched on when they were talking about job opportunities was around transparency and frameworks, and how that is kind of an emerging world in the impact space. And one of the questions from the audience was, to what extent are retail investors getting transparency with respect to their impact investments, and how is that being provided? And maybe I'll have Jake go first, and then Jodi, you can talk a little bit more about the bond world. And Yuliya, if you want to chime in after, feel free.
Yeah, sure. So Openvest is an interesting kind of case study in this. One of the things that Openvest did differently really early on, when we were super focused on retail investors and had the app, was impact reporting, and using impact metrics. And so it can be a challenge when you're not directing funds specifically towards impact goals to be able to do that, right? Like one advantage of CDFI investment or something like that is like the use of proceeds is, generally speaking, very clear. Sometimes there are metrics or outcomes tied to that money, right? Like it's a very different world. It's almost an obvious thing to report on impact metrics or metrics about what the money's doing. In the public equity world, what you're essentially doing is saying, okay, what metrics do I have that are comparable and or cover enough companies if they're broad, or completely cover the relevant companies if it's narrow, such that I can make accurate, consistent, repeatable measurements about what a certain amount of money in ownership these firms means in some way that is meaningful. So one good example of that is carbon metrics, right? So thankfully, the disclosure of carbon metrics has only been improving over time. And we can do something like, you own XYZ stocks, you have this many shares at this much money, that equals some percentage ownership of the company. And so we can frame the amount of carbon, the carbon footprint of your portfolio in terms of sort of the weighted average amount of shares you own of certain companies based on their emissions. That's a pretty cool metric that we can show you. And that is an aspect of this, of like sort of impact transparency, right? And then you can say, well, if I bought this S&P 500 ETF, or I did this fossil fuel free OpenInvest portfolio potentially, I can see what the embedded carbon looks like between one and the other. And then if we can go out and source more and more metrics like this, we can do more and more interesting impact metrics, which is what we've done. And so that's how we do it. We do it with quarterly impact reporting for our clients. There's also impact metrics to the app if you're an app investor. And then we actually also have like a standalone product that allows you to view any portfolio upload in terms of all of our impact metrics and data. And so that's how we've tried to deal with it, is to try to create tangible, understandable, transparently calculated things that give you some information about your portfolio beyond financial reporting, that is sort of germane or particular to the things you care about from an ESG or values alignment perspective.
Thank you. Good, Jodi.
Okay, sure. Well, I think the easiest part of it is when you have an issuer where all they do is related to impact, like a community development financial institution or a supranational that exists to alleviate poverty, because they have a mandate to act responsibly, and most of them produce impact reports, and they're used to doing that because that's part of their DNA, right? That's what they're designed to do. That's what investors have always looked to them and held them accountable, even if it was their bank lenders, not the investing public. Before the investing public got involved with these types of issuers, they've had to produce impact reports. You can measure jobs created, you can measure units of affordable housing financed. And so that is something that investors have always had access to. And I think that's getting even better at those issuers that purely exist, let's say for community development. Where it's not as clear is when you have an issuer out there that has maybe gone to market with fixed income, and they have a bond and they say, I'm going to use it to produce electric powered vehicles. Well, you can measure the number of vehicles financed. That's one way, but I think that it gets a little bit hazy in that, cash is fungible, meaning that it can be used to create new electric vehicles, or perhaps it can go to general corporate purposes, and the investor really doesn't know. And so what it comes down to is the investor doing their homework, the investor looking within the 10Ks, within any impact reports that a non 100% impact issuer is producing, and you have to do the homework and make your own decisions if that's adequate for you, right? So are you getting the information that you need? So I think that with a CDFI or a supranational or a Calvert Impact Capital, if you're an investor just starting out in the space and you want to have the most comfort that your dollars are going toward the intended purposes and you're going to get the most information about how your dollars are being used, that you would start there.
Great, thanks, Jodi. And that kind of ties into a next audience question that I'm going to give to Yuliya around what should be a first step for a new investor who wants to invest in impact funds. visit
There's
my
a lot.
CNote.
Well, I feel like before I should have like opened my mouth. I should say I'm not an investment advisor. I'm not here to give advice and to make my compliance team happy. I mean, there's a lot of tools, and obviously there's mycnote.com. There's obviously OpenInvest.com. There's others. There's other out there. There's also like local CDFIs that you can find in your local communities, which I think this is probably like the coolest way to really get involved, to the point where you can actually see the change happening in your community, because that CDFI that is working in your community is putting the money to work there. And you can find CDFIs that are in your communities on, I think ofn.org, right? Probably Anna is the best source. And then from there, you can find the websites of those CDFIs, and you can see if they offer, notes and products that you can invest, outside of just donating them and working with them. I would say also look where your cash is. I think we have a lot of cash sitting in big banks, and right now everyone is flooded with liquidity, and big banks definitely not doing anything good with the cash, and just because there's very little way to deploy it. And so think about having an account at credit union, or there's actually CDFI banks. CDFIs are not just loan organizations that lending the money and only have that size of the business. There's actually CDFI banks, which again you can find I think on both OFN website and CDFI fund website. And if you have a bank in your area that is CDFI, I would highly recommend it to have an account there. I think this is kind of like a very easy and a very simple way to start impact investing. Just think about cash. Again, understanding that many of us don't even go to the step of investing, but if you do invest, then again, obviously there's investment solutions. There's investment solutions out there.
Great, thanks. And I'll just weigh in also really briefly. I think one thing that I've thought about in my own impact investing journey, which is also a little not as far as long as I would like it to be as an individual investor, but I think thinking about what you care about and what issues you really want to focus on can help you narrow down the areas you want to research and how you can impact change. And then there's this other really great group that I've been involved in that's geared for women, but it's called Invest for Better. And they have a lot of good tools around the different pockets of capital that you may have as an individual and how you can put it to work. But it is, yeah, sorry, go ahead.
No, you'll go on. I'll finish up.
Yeah, I was just going to say, I think it can be really daunting as an individual, because it is a little bit fragmented right now, but I think that that's something that will change hopefully in the near future.
Yeah, I think there's also there's actually like more again, another way I guess to get involved. There's also like more ETFs that are coming up, that have social social filters. Again, if you do have a Schwab or other brokerage account, you can do that. And then and I don't know what their opportunity is, but there's also like a lot of resources out there that I think we can share with the audience, and there's going to be just like a list of different opportunities how to get involved, because it is a lot to process, and I think some pinpointers would be helpful.
Yeah, and Anna, I think to point out the US SIF on their site, they have a great many resources for individual investors to start their journey and learn about the different options that are available to them. And even for those investors that don't have an advisor, I would encourage you to pick up the phone and if it's Schwab, give them a call. You don't have to have a specific advisor. You don't have to have that type of relationship to ask the questions and be directed, because it's evolving in terms of even the education of the personnel at the broker dealers with whom Incapital interacts. It's required now that they understand more and more the products that are available, not only in the equity world. I think that's always been the easiest way to express a view, but with fixed income. So across your portfolio, with your cash management, is it a CD, right? FDIC insured. There are different ways. And I would say don't be intimidated to pick up the phone and ask questions. And if the person on the other end doesn't have the answer, you should push on them to get you the answer, because you deserve it, right? If they have your capital with them, and I think that accountability is going to be key to advancing the ball.
Great. We're almost at time, so I'd like to give the opportunity for final thoughts from each of the panelists before we say goodbye for the evening. Yuliya, you're unmuted, so do you want to go first?
Oh, wow. Okay.
Putting you on the spot.
I don't know. I feel like exactly. I feel like you had really nice calling. I would probably just say, it's always nice to end with call for action. And so I think, I would definitely encourage you to read, and again, to reach out to Anna, to reach out to me. I don't know if Jodi and Jake probably open as well. Again, ask for resources, ask for advice. I'm doing a lot of speaking. I'm very passionate about this, this field. And I think I also find it's really good to actually have another person who can keep each other accountable. It's one of those things where, like, if I promise in public, right, like if I make a pledge that I'm going to do that, I'm actually going to do that. If I'm just going to promise myself, I'm probably never going to do that. So maybe like think about creative strategies for you to really pursue that impact investing for your own portfolio, but also in your own life. And that field is changing rapidly, and I think they'll have a role to play to make that just more mainstream, right? And actually, I would love at some point us don't even talk about impact investing, but actually say investing, and it would automatically assume that it's already impact. Because right now you just kind of like play this game. It's like there's real traditional investment, there's impact investment. We're like, can we actually get to the point where it's going to be just all the same? So that's my world that I'm dreaming of here.
I would just follow up on that and say, this has been going on a long time, but it has only gotten big recently. And so like smart, interested, passionate people are needed. There are many more companies and funds and strategies and approaches to be founded and started and kicked off. That could easily be any one of you. It's never been a better time to be an entrepreneur in this kind of environment and in this kind of space. There's more money available. There's more people listening. There's more people who've seen it work. Some things have failed, so people can tell you what to avoid. So I would just say, if you know that you're passionate about this and it gets you out of bed, then just go for it. It'll work it out, or it will work out.
I think I would reiterate, my last statement, that if it's important to you and you're not finding what you need, be it from an investing perspective or from a career perspective, seek it out, ask questions, ask others, lean on others, gather information, because the opportunities, they will present themselves. Right now, it might be a little bit more difficult to vet them, given how it's exploded so quickly. But I do find that those that are truly dedicated to it, it becomes apparent, right? If you do enough homework, it becomes apparent within those organizations who's doing it right and who's doing it just to stay relevant in part of the conversation. So, that advice to you is try to get to a place where you can determine which type of organization it is, right? If it's a career that you're seeking out in terms of your investments, like I said, ask questions, and you deserve the answers.
Thank you, Jodi. And my last thoughts are, I think that this past year with the COVID pandemic and the racial reckoning have really awakened the opportunity for us to re-envision what capitalism looks like. And I think there's an opportunity for us all to play, not just through our own assets, but through our careers. Whether you even go to a corporate environment, there's a lot of opportunities to push for your values to be integrated into that workplace and make it a company that Jake wants to put on OpenInvest. So I really appreciate all of you attending today, and hope to stay in touch. So I think with that, goodbye.
Thanks.
Zoom
Thanks,
goodbyes are
everyone.
always so awkward.
I know. Thanks, Anna, for moderating.
Thank you.